How do economic factors influence mortgage refinance rates? Have you ever wondered how the economy affects the rates on your mortgage refinance? Understanding this connection can help you make smarter financial decisions. Economic factors play a big role in determining mortgage refinance rates, which can impact your real estate investments. To start, the overall health of the economy is a major player. When the economy is thriving, with low unemployment and strong growth, mortgage rates usually rise. Lenders and investors are looking for higher returns during these times. On the flip side, when the economy slows down or enters a recession, mortgage rates often drop. This is because lenders want to encourage borrowing and support the housing market. For real estate investors, this means refinancing can become more attractive during economic downturns, potentially lowering costs and improving cash flow. Inflation is another key factor. When inflation rises, investors typically demand higher yields on bonds and mortgage-backed securities. This demand for higher returns leads to increased mortgage refinance rates. Conversely, when inflation is low or stable, rates tend to remain just lower. The Federal Reserve's monetary policy also has an indirect impact on mortgage refinance rates. While the Federal Reserve does not set mortgage rates directly, its decisions regarding benchmark interest rates influence the overall cost of borrowing. For example, if the Federal Reserve raises rates to combat inflation, mortgage refinance rates usually follow suit and increase. Conversely, if the Federal Reserve lowers rates to stimulate the economy, mortgage rates tend to decrease. Real estate investors should keep an eye on Federal Reserve actions, as they can signal shifts in refinance rate trends. Government policies and global events can also sway mortgage refinance rates. Policies that promote homeownership can increase demand for mortgages, which may push rates higher. On the other hand, geopolitical events or financial crises in other countries can lead investors to seek United States bonds as safe investments, which can lower domestic mortgage rates. Understanding these external influences can help investors time their refinancing decisions better. Market conditions, including trends in the bond market, oil prices, and employment levels, further affect mortgage rates. Mortgage lenders often fund loans by selling mortgage-backed securities, so the yields on these securities are closely tied to broader economic conditions. When yields rise, mortgage refinance rates increase, and when yields fall, rates decrease. For real estate investors, knowing how these economic factors influence mortgage refinance rates is essential. Lower refinance rates can lead to reduced monthly mortgage payments and improved investment returns. On the other hand, higher rates might discourage refinancing or requiring more careful financial planning. Staying informed about economic indicators like inflation, Federal Reserve actions, and employment data can help investors anticipate rate movements and optimize their financing strategies. In summary, mortgage refinance rates are influenced by economic growth, inflation, Federal Reserve policies, government actions, and global events. By understanding these factors, real estate investors can make informed decisions about refinancing, reduce borrowing costs, and improve their investment profitability.